Welcome to The Real Recipe, the podcast that brings you the perfect blend of real estate trends and topics, where we serve up fresh insights and sizzling strategies. So let's get cooking. All right, we're back. We're back with another episode. Today we are going to discuss an interesting topic right now in the market, which is the Fannie Mae 5% down multifamily. That is all the rage, apparently.
It's like the 2-1 buy down. So hot.
It's all the rage. It's so
all
hot.
The
right?
rage.
So hot right now. So today we're going to talk a little bit about what it is, what we need to know about it, and
How do we feel about it?
does it really make sense?
I don't know.
Yeah, I don't think it does. But
Personal opinion.
Okay, yes. In my humble opinion, don't see where there's going to be a lot of traction here.
Right.
I think it's more of a vanity play for Fannie Mae and to put this out there. We're doing something, but yeah, let's jump right into it. So, Fannie Mae, the government-sponsored agency that is focused on mortgage financing, announced a new initiative that they would allow 5% down on a multifamily home. So a 2, 3, 4 family, 2, 3, and 4 family homes, they would allow a 5% minimum down payment, and that's down from 15 to 25%, which is what it was previously. The move is expected, according to them, to benefit many prospective home buyers or homeowners who have been deterred by the traditional high down payment requirements for such properties. Okay, fair enough. The new program is designed to cater to those looking to invest in multifamily dwellings, such as duplexes, triplexes, and four families. By reducing the upfront financial barrier, Fannie Mae hopes to encourage a broader range of individuals and families to consider multifamily homes as a viable home ownership option. It's in Fannie Mae's eyes, it's a mission to provide liquidity, stability, and affordability to the U.S. housing market by offering more flexible financing options. Okay, that's the idea. So let's talk about what we need to know about it, kind of the nuts and bolts of it, and then let's talk about what our opinions are of what this actually is, because I think. One of the things, as I know you have seen, is so many people took up the torch and went to social media on this, and this is the most amazing thing in the world. And I think that it serves a purpose, but I think that the purpose that it serves is very minor and ultimately is not going to be as illustrious as everybody is portraying it to be. But the new policy starts the weekend after November 18th, 2023, so in a little less than a month from now. Fannie Mae will allow 5% down payments for owner-occupied 2, 3, and 4 family homes, which obviously is a major policy shift for them. Again, coming down from 15 to 25%, down to just 5%. The qualifications: first-time buyers can use rental income from the 2 to 4 family property to help them qualify for the loan, provided they have a current housing expense, future rental income. We use less than 25%. We use a 25% vacancy factor. So we can talk about what that means. Basically, you're taking 75% of whatever rental income you're using, and that's what you use as your income to qualify. Can be used to help the new homeowner purchase the home. And then again, the motivation there from Fannie Mae is to help with the home affordability aspect of things that's becoming such a huge issue right now nationally. The one thing it leaves out, which we haven't gotten clear guidance just yet on this, but the one thing that it does leave out is reserve requirements.
Right.
So previously on 2, 3, and 4 family homes, you had a reserve requirement that was required in order for you to above and beyond your down payment and your closing costs, you had to have a certain amount of money in reserve in order to do these loans.
And what was the minimum for that?
I believe it's 6 months.
Okay.
6 months. So some people are probably not. That's what I think is going to get everybody. Like all of a sudden, okay, great. You can now afford a 4-family house. Okay.
But can you?
But can you? Because, you're going to need all this money now, right? So that's kind of the idea behind the program. I think it's a good program. I think that they're trying. It is something that they're trying to make it more affordable. The Fannie Mae, the big difference right now is if you're going to buy a 2, 3, or 4 family home and you're going to do less than, 15% as would be the minimum, you're traditionally going to go to an FHA loan. Okay. FHA, as we've discussed before, is certainly a more costly loan when it comes to cost. Certainly because of the insurance. The other aspect of that is that FHA requires on a multifamily home, they require something called the self-sufficiency test. And what that is basically the same vacancy factor that we talked about before, right? So the rental income on the property, 75% of that must cover 1-for-1 the mortgage. So if you have a $1,000 mortgage payment, the rental income minus this vacancy factor has to be at least $1,000. So you have that self-sufficiency test. And the idea being that you want the property to be self-sufficient, that you don't want to be stuck in a position where you can't rent it and it can't sustain itself. Which, truthfully, if you're buying a multifamily house, you kind of want it to be self-sustaining. You don't really want it to be a burden. So
I think if you buy a multifamily, you're looking at the fact that what if I can't get a renter in there? If there's someone in there, what if someone moves out or stops paying?
Yeah,
that's always going to be a risk, whether it's going to be owner occupied or not.
Yeah. So I mean, look, I like the idea of this. I think it's a good idea. I think it's all it was a news. It's a soundbite. That's, for me, that's all this is. Because when you stack it up against an FHA loan and you stack it up against what the reality of it is, very few people are going to fit into this box. And the only reason why you would go here for a conventional loan is if you're failing the self-sufficiency test. That's really the only reason why you would go to a conventional. Otherwise, you're going to gravitate to an FHA because FHA, the mortgage insurance is because they lowered the mortgage insurance. Mortgage insurance is going to be lower now. The rate is probably going to be better. Yeah, you're going to pay upfront mortgage insurance on it, but the rate's probably going to be better, which would offset. So you're net going to be in a better deal, pretty much regardless in FHA rather than being in a conventional loan. But again, one of the things that they haven't mentioned yet, which is going to come out soon, is going to be the reserve requirements for this. If it's 6 months reserves,
you're really going to shrink that box of who can fit into it because if you have more than 5% to put down, you're putting more than 5% down. You're robbing Peter to pay Paul. You're saying, okay, I can put 5% down because I really need the rest of it to keep up with that 6 months minimum reserve requirement.
Right. So, it's such an interesting topic because I just don't see how you're going to see a lot of people actually go for this type of product. And not that I'm trying to be the negative. I'm just trying to, let's have an open dialogue about it and whether it actually makes sense for the consumer to know, like, hey, should I be doing this or shouldn't I be doing this? Does this really make sense for me? And look, I mean, at the end of the day, if you're buying a multifamily house, you want to be able to have money in reserve. I mean, we've talked about this extensively, right? Because you don't know, right? What if you lose a tenant? What if a tenant becomes a professional tenant and then all of a sudden they stop paying and now you're stuck? Now you're
can't get them out.
Right. And one of the reasons why you would want a reserve is for that reason.
Right.
Secondarily, if people have been able to accumulate 15 or 20% down, that shows you that they have the ability to accumulate savings, which means that they're probably in a better position financially anyway. If somebody has 5% down, they have no reserves or very little reserves, it's much easier for that individual to walk away from that loan and let it foreclose rather than try to save the investment or try to make it work financially.
Agreed.
And that has been proven, over time, through a number of statistics. So
I just think it's interesting that one of the positives that it mentions is the liquidity of the property, because there's really not much liquidity in it if we see a change in the market, which, there's a good chance that could happen. But if you have 5% invested in the property and property values go down, you certainly you don't have enough to leverage to purchase another property as an investor. And like you said, it makes it easier for people to walk away. But if you have to sell it for some reason, what's that going to look like?
Yeah.
That's going to, you're looking at more potential for a short sale in that scenario.
Yeah. I mean, that's a broader discussion about what's the state of the real estate industry as a whole, where we are, from a sales standpoint. But yeah, I mean, the idea of wanting to make houses more affordable, that I don't see how putting 5% down is really, you're not changing the affordability of it. You're just changing the amount of money you need
to get there. Some stake in the game,
right? Which is the whole crux of the whole thing was like, well, yeah, okay, so you're putting down less money. You still have to qualify normally. You still have to have a decent income. But you're still going to pay a ridiculously high interest rate at this point. Mm-hmm. Why not try to create a first-time homebuyer program with incentivized rates that they have some of these homebuyer programs, but the rates really aren't that much better than what a normal Fannie Mae or Freddie Mac rate would be. Why don't you try to implement it there? That's why I felt like earlier on when I saw this coming out, it's like a vanity project. It's a way for me to put out a soundbite or a news blip and say, hey, we're helping the people buy multifamily homes with less money down. And the other thing about that, I just thought about this too, is how much fraud do you think is going to start to happen in this little box?
With
meaning that
qualification?
No, meaning that how many investors, because I'm sure you've probably seen it or heard about it on Bigger Pockets and on all these other forums.
Everyone blew up Bigger Pockets when this came out.
We can do 5% down. Yeah. Cha-ching. Oh, I only got to live in it for 60 days? Oh, great. Yeah, sure, no problem. I'll write that down that I'm living there. So I think that for me personally, as nice as it sounds as a soundbite, you're raising the risk of default because your borrower is putting less money down. Mm-hmm. You're raising the risk for fraud because you're now allowing an investor to buy a house with 5% down. Mm-hmm.
And we already see that with single families to begin with.
Some guy's not going to figure this out. Like, oh, I can put 5% down instead of 20% down. Okay, we'll figure that out. And they're listen. He may be able to justify that investment, but we think that's not coming.
Do we think there'll be any more due diligence as a result of that? Like them keeping a closer eye on who's...
No, they can barely get out of their own way.
That's true.
There's no one policing this stuff. And that's the other funny part about it is the way mortgage servicing works and the way, the investor community polices itself has nothing to do with being proactive. It's all reactive. So the only time that somebody would police this in a broader way would be if there was some regulation or some entity or some compliance aspect of this that forced that behavior. Right now, the only way that happens is literally if you stop making your payments, then the file goes in for audit, and then they figure it out. Oh, he's not living there. Oh, right. Well, no, that's a problem. And then they try to sell the loan back to whoever originated the loan, and then it becomes a giant mess. But that's the only.
Or deed transfers. Sometimes they'll pick it up. Because sometimes you have they're like, all right, forget it. I've lived in the property for however long. They start renting it out, and then they want to put it into an LLC. And they put it into an LLC, and then when the loan gets sold or transferred or something like that, they're obviously running a title search on it, and they're picking it up as someone did a mortgage transfer without making the lender aware. Mm-hmm. And that's a red flag for them.
It's a red flag, but it doesn't stop. It doesn't stop it.
Mostly when it goes into default, you're saying?
Yeah, it, for the most part, default is when they start really
digging into it.
Yeah, they start flipping over every stone and they start looking at it. Yes, that does happen. It's so minor and so minute that it virtually doesn't exist. But I don't know. I look at a 5% down, multifamily loan, and say, yeah, on the surface it sounds great. And I think a lot of people took up the torch or took up the mantle that this is going to be an amazing product. The reality is when you go to do your application and you go to get the financing, you're going to find out that it's not really worth it, or that you may not qualify for it because the one thing that they're not talking about again is the reserves, or how much reserves do we need? 6 months? You'd argue that at 5% down, you'd want way more money in reserve because you're not really putting any skin in the game. 5%, you're just thinking about that. You're buying a $500,000 multifamily house, $25,000 out of pocket. I mean, for the most part, people have $25,000. for the most part. Whether
if they're buying a multifamily.
Yeah, right. Like if you've got IRAs.
On the whole, no.
Well, I get that, right? But if you've got, if you're halfway intelligent with your finances, you've got money. You've got either an IRA, 401k, you've got some money, so you've got some reserves. Your ability to accumulate savings is a little bit of a different conversation because of some of your spending habits maybe. But you've got 5% down. That's not really a lot of skin in the game.
Now, are they for reserves? Do they take into account things like 401k or anything like that? They do?
We can use that. Yeah, we can use that. But here again.
But again, is that financially sound to be like, oh, I got 6 months of reserves in my retirement plan? Literally, not so much.
Listen, I've seen it happen all the time. Guys, people run into a situation financially that maybe they didn't account for. Maybe they weren't saving as much for retirement, but they've had to use their retirement because they don't have any money.
Right.
So they got to take their money out of their 401k and use it. But that's only 6 months. How many? Professional tenants are in there for years sometimes before you kick them out.
6 months goes fast. I think when people.
Like you lose your job and a tenant tenant becomes a professional tenant. Now all of a sudden that $2,000 a month in rent from the other two units doesn't cover the $5,000 mortgage payment. What do you do? Well, I'm taking the $2,000 a month, putting that in my pocket, and I'm going to let the mortgage go because now you're surviving on the $2,000, right, or $3,000, and that's what happens. So that's why I feel like it doesn't sound as good as it people are making it out to be. Not that I'm trying to be negative about it. I just the practicality of it or the reality of the situation is you're going to gravitate to an FHA loan just because it's going to be better. You're going to have better interest rates. Yes, you have to deal with the PMI. The PMI aspect of it, which is going to be on there for a lengthier period of time, actually for the whole loan.
Unless you refinance out of it.
Unless you refinance out of it. But that's the other thing too. In a couple of years, you're going to refinance out of it. And if the market continues on the same pace or trajectory that we're on now, it probably in a year or two, you're going to have 20% equity anyway. So you just refinance and get out of it.
Right.
So, there is that aspect of it. I don't know that I see that as that shouldn't be your
That shouldn't be the reason you do it.
Yeah, right.
But I think with all things where they're making it easier for people to get money, you still have to rely on the consumer to say to themselves, I'm making a smart financial decision here. Every day we see people that are buying houses that are literally scratching up every single penny that they can.
Yep.
To the point where they're like, I don't know if I can close this week because I got to wait until I get my next paycheck to be able to bring enough money to closing. So while it's a great option, it's a good conversation starter. Like you're saying, for someone in your business, realtors are certainly posting a lot of information about it. It's still up to the consumer to be able to make a smart financial decision and say, this is great. I could have done it at 15%, 10%, and 5% definitely. But no one should still be scratching, everything they can together just to be able to get that 5%. And maybe not even having reserves.
I do want to clarify something though. The FHA self-sufficiency test is only on 3 to 4 family houses. Right. It's not on 2 family houses. So that's something to keep in mind for people.
But everyone should have their own self-sufficiency test when they buy a property, whether it's a single family or multifamily, whether it's someone stops paying the mortgage or you move in and, shit hits the fan and you got to get something replaced.
Well, think about that.
Everybody's hot water heater always breaks or something as soon as they move into a house. It's just like the thing that happens.
Right.
So if you move in and you have nothing left over, that's a bad move. It's a bad move.
Well, think about it like this, right? So you buy a house and you're living in one unit and you're renting out the other 3. Okay. The way that self-sufficiency test works is the other 3 units, the rental income minus the vacancy factor, should support the mortgage. And if it does, it's typically a good investment, right? But that should also be the same view that somebody buying a home should take when looking at this. Okay, so if I'm getting $1,000 a month or $2,000 a month, and my mortgage is $1,500, and I take 25% of that, and it's 15%. Or $1,500. My mortgage is $1,500. It's a good deal. Right. Okay. If I lose my job, I have no income coming in. The other 3 units support the mortgage, and I can live here and still be. You can figure it out, right? And not default on the loan. If you're doing conventional 5% down, and you're just winging it with no reserves, no nothing. Not that because FHA doesn't require reserves, but it's if you're winging it like that. you could be in a position where you're hurting yourself financially. I don't know. And the rate's probably going to be higher. Rate's probably going to be significantly higher, and the mortgage insurance on conventional is going to be way higher. That's the other thing that nobody's talking about. The mortgage insurance on FHA right now is 0.55. Oh my God. Well, no, but listen, on a big, a multifamily, at least around here, it's a big mortgage. It's not, you're not getting one for $200,000, right? You're getting a $600,000, $800,000 house, and your mortgage insurance. Let's say your mortgage insurance is 1.5% or 2% annually through conventional. I mean, you're talking $1,000 a month potentially in mortgage insurance. That's 5% down. I mean, it's going to take you a while for that to amortize off. And that's probably another topic we should talk about
the
is
PMI,
the PMI thing. But the only advantage there with a conventional loan is if it's a year or two and let's say the property appreciates in value, you could potentially have the mortgage insurance come off. But that's significantly different than what it would be on an FHA loan,
right?
And so that's why I think people are just naturally going to gravitate to FHA anyway. Yeah, you may have a few that fall out because of the self-sufficiency test, and that's probably becoming more of a thing now anyway, because rental incomes on properties haven't quite caught up with the values just yet. So you're probably seeing where some of the FHA loans aren't quite working out the way that they should, but look, I guess it's a vanity project for Fannie Mae.
We'll see.
I don't see if it's going to go anywhere.
We'll see what happens once they start talking about the reserve qualifications.
Yeah, let's see
where that leaves people.
It'll be funny to see what happens on the 18th.
It's going to be like, and it's gone.
Right.
And it's gone.
Right.
no one can get it.
Right. Exactly. Yeah. That sounded great.
Yeah.
Oh,
on to the next thing. Let's bring back 2-1 buy downs.
Yes.
Bring that back.
Actually, funny enough, those are coming back, but they're coming back in a more meaningful way now. I know we're getting off topic here, but they are coming back now, and they're coming back in a meaningful way because sellers are more willing now to do concessions than they have been in the past. So.
For the next topic.
But hold on. Think about that. You could do a Fannie Mae 5% down multifamily, get a concession from the seller to have pay no closing costs, put 5% down. I mean,
I feel like these are the things that get you up out of bed in the morning.
They do.
How excited you just got about that.
Well, because it cracks me up, because we've been lending money we've been doing for thousands of years. And yet we come up with these topics and we go to ourselves, this is a great idea. Oh my God, we're gonna solve the housing crisis right now. And then magically in 20 years from now it fails miserably. And we look back on it and we go, could have seen that one coming a mile away.
Yeah.
And not because I'm trying to be so negative about it, but this is one of those things where I see that coming. It's like, okay, here's the train slowly coming at us.
Right.
Like, did we not think that we were going to have fraud? Did we not think that people's 6 months of reserves probably wasn't going to be enough for that product? Did we not think that these were important things? Hey, maybe I should have a minimum 700 or 720 credit score. I shouldn't be giving this to the 640 borrower. Not that the 640 borrower would qualify anyway, but you know what I'm saying? Like,
right.
There's certain rules.
Probably should have gone off the tracks.
Yeah, like
there's the headlights.
Certain things that we know beyond a shadow of a doubt from lending money for years and years and years and decades, and have figured out that, hey, the silliness of this is that you have some bean counters behind the scenes who are going, oh yeah, well, if only 4% of these mortgages default, we'll make this amount of money.
They're taking that into consideration.
They are.
So.
They are. But this is one of those few times where I look at it, just me personally, and say to myself, okay, you're not really serving. You're not serving the community. You're not serving people in the right way. Home affordability is not about buying a multifamily with 5% down. That's not the problem. It's single family homes where people are being forced to pay, 50%, 60%, 80% more than what they were just a few years ago. And now they're struggling with that because interest rates are now double and triple where they were, quadruple where they were just a year or two ago. Right now, if you look at a 3% mortgage, or a 3% mortgage that you took out, a year or two ago, right? And now you're at 8%. The payment's almost double for the same amount of money that you're borrowing.
Right. That's like I told you the other day when I went to look at that one house.
Right.
It's
Payment's almost double.
Half of what we bought the investment property for a couple years ago, and the payment's exactly the same, and it's half the price.
Right. Isn't it wild? It's wild to me. So that's why I said it before and several times. It's I think it's a soundbite more than anything else. I don't really think that it has teeth to it or any traction to it that's going to make the difference in an already stressed housing market.
Right.
It may help a few here, odd situations here and there, but the reality is that we as an industry need to do better. We need to be better. We need to be able to solve the housing crisis in a better way. This is not it. We need to get interest rates at 8%, while they probably should be there, given some of the economic things that have happened over the past few years. That is really where we need to focus our energy and effort, and the government, however you can do that, that remains to be seen. But that's where we should be focusing our energy and our effort. Maybe doing a 40-year mortgage, maybe doing some things like they do in other countries, with longer term mortgages than just 30 years. America is really the only one that I think that has a 30-year mortgage. Most countries have longer mortgages. So. There's different ways to solve for the problem, and I don't 5% down on a multifamily is not really get us there. Yeah, it's not going to solve. You're talking about a tiny little portion of the housing market. So, all right. So if you're thinking about buying a multifamily as a conventional loan, you can probably get an FHA better. The FHA deal better. So, all right.
All right. Till
See
next
you soon.
time.